Hi, I'm John.
And I'm Julie.
We're the hosts of the Hartford Fund's Human Centric Investing Podcast.
Every other week, we're talking with inspiring thought leaders to hear their best ideas for how you can transform your relationships with your clients.
Let's go.
Amar, welcome back to the Human Centric Investing Podcast. We're so happy to have you here today.
Great to be back. Thanks for having me, Julie.
You know, Amar, it seems like President Trump has been in office for longer than he actually has been at the time of the recording of our podcast, because so much stuff has been going on. There's been proposals around tariff talk, and there's proposals, and everybody's following the Doge stuff. And how do you, as a fixed income strategist, kind of keep track of which ends up, and where do you think the overall market is these days? I hear a lot of financial professionals just talk about confusion, up in the air, wait and see. Like, what's your view of the world these days, just a short while into President Trump's term?
Yeah, I think it's really important as a markets professional to try to find a little bit more of the signal and all the noise. I guess to paraphrase something that's pretty common in statistics, um, what you're really trying to understand is not necessarily the rhetoric, except for in the sense, what the rhetoric is trying to communicate about end goals, and far more on the actual levers that are being pulled. For example, there's been a substantial amount of talk about tariffs. Well, we also know that some of those tariffs have been postponed, while some have actually, gone forward. And you know, it's very hard to say exactly what the tariff structure will look like in several months, because part of it is, yes, a desire to actually utilize tariffs for a variety of reasons. And then another part of it is also part of the sort of negotiation that the new administration is having with trading partners. So in that sense, I think it's great. Obviously, you need to be aware of what's being said, but it's really important to focus on what actual things are levers are being pulled, whether it's with tariffs that are implemented, or whether it's with, just as importantly, and maybe even more importantly, the budget reconciliation process that's going on in Congress, that's extremely complicated, that's sort of governed by a very, very thin majority in the House, and right now appears to have sort of different ideas in the Senate version and the House version. So I don't view it as confusion. I view it as extremely messy policymaking, but that's not actually that unusual, in a number of decades. And I mean, looking back over a number of decades, I think probably what's more challenging is for people to kind of to hear a lot of the noise around that, and some of the noise, is it can be unsettling to market participants, and because of that, it kind of obfuscates doing a lot of the sort of hard grunt work of looking at what's actually happening.
Obviously, with all that noise, how has the bond market been reacting? Maybe we can kind of start with the big picture and then narrow in on some of the specifics.
So the bond market, I guess the right term is, Julie, is reactive rather than predictive, right? Like sometimes the bond market is in prediction mode, where it's saying, hey, given all the inputs we know about the economy, about inflation, about Fed policy communications, here is kind of the path of rates, and what we think, inflation is likely to be, along with real growth. I actually think your usage of the term reactive is very appropriate, because the bond market has been in sort of reaction mode, not just since the inauguration, but really probably since the summer of 2024, when the probability of not just President Trump winning that election, but also the chances of what's called the trifecta, or the sweep, which is the House, the Senate, and the executive branch. And what it's done is it's sort of shown the market at various times has been concerned, and especially the last couple of months has shown growing concern about some of the tariff related discussions that have been happening, and the possibility of inflation creeping back in at a time when it seems like the cycle had somewhat damped a bit. Now, of course, it's really hard to say, right? Like, uh, you have to ask what type of tariffs, what are the exemptions, are there retaliatory tariffs that follow, and all of these things are first, second, and third order effects that the bond market right now is having a very hard time grappling with, and hence has been in reactive mode. Just as a very good example, over that weekend when it was announced that there was going to be significant tariffs on Canada and Mexico, you saw an upward movement in bond yields and inflation break evens, which is the bond market's sort of proxy for what inflation is, widen out. And then, of course, on Monday, it was told that those were going to be delayed out, several weeks or a month. And then the bond market, became sort of calmed down. So right now, I think it's a lot of wait and see on what the end actual policy is on the tariff side, and of course, like the other 800-pound gorilla, which is the budget reconciliation process, the extension of the 2017 tax cuts, how much new additional supply or deficits happening. Like those are the things that the bond market's kind of in a reactive mode to right now.
So, Amar, when you say reactive, I hear the word react, and immediately I think volatile,
Yeah.
right? Because it seems like, based on and it's funny, Julie and I did a podcast with one of our political commentators. I think it was in January prior to the inauguration. And he stressed to us, just be careful you're not paying attention to every little tweet or every little soundbite, so on and so forth. Do you think the bond market is kind of adjusting to that? And would you say to investors, you've got to be a little bit careful about making kind of snap decisions based on a 1 day or a 1 week movement in the market?
Yeah, that's exactly right, and that's a little bit of what I alluded to, which is to sort of separate out like the tweets, uh, any kind of like a lot of rhetoric, and actually kind of look at like, well,
Hmm.
what are the levers that are actually being pulled here, and that's the job of investors on our side, certainly, but it's actually just a good thing too if you're an allocator and your job is to think a little bit more longer term and to really do that, if you're going to be reactive to every single tweet, which can, clearly turn on a dime, just that one weekend is, I think, uh, a really good kind of proxy. It's going to be a very expensive time for you during a period of volatility. So what's kind of best to do is, look at your asset allocation, look at what your end goals are, look at what you're getting paid from a valuation and yield perspective. And I say yield because I come from the bond side, and that is, one of the key drivers of how I think about the world. And allocate to that. And I always say, like, give your managers the flexibility so that we can obviously, people who are studying all of the data coming in at most periods of time, uh, calibrate risk more from what our perspective more appropriate.
Amar, there's been so much focus on Doge, the Department of Government Efficiency, and obviously the headlines and the tweets, they're just never ending. And I'm just curious from your perspective, obviously there's so much of the US federal budget that goes to other programs like defense spending. How much of an impact can Doge really have on reducing federal spending, in your opinion?
Yeah, yeah. So look, just at a top line, like, before we were speaking, I was just catching up on some old, uh, you know, fiscal year end numbers for the federal government, as one is wont to do. And if you look at like 2023, for example, yeah, like there was like north of like $6 trillion of like federal spending that took place that year, and over 60% of it, the majority of it, was for what you call mandatory spending, right? Spending where there's a formula that Congress has determined, like Social Security, Medicare, Medicaid. And like that formula is like your expenditure, right? Like that's what's
Mhm.
going out the door. You can change that legislatively, but it's a hard lift, and Congress has to go through the sort of messy, business of recalculating things and so on. And like of that 60% number, two-thirds of that number is Social Security, Medicare, Medicaid, income security, veterans benefits, like stuff that, to change, you literally need to change the formula and the allocation that Congress is giving it. So, like, and again, that's possible, but like that's not what Doge is doing. It's called the Department of Government Efficiency, and I guess the idea is you're supposed to trim the fat from like spending. So if you go to the other sort of 40%, it's what's called discretionary spending, and like half of that spending is military. So like the big sort of areas of the federal budget, like the really like big areas are, Medicare, Medicaid, Social Security, defense, and yeah, like those are areas that you really need to think about, like things like the procurement process, the compliance process, all things that are sort of very granular on if you want to make like changes or tweaks to it to kind of save money. And by the way, part of that also is like on the non-discretionary side, the mandatory side, that first chunk I talked about, there's the formulas as well. So if you're not like addressing those, it's actually quite hard to bring down, deficit spending without Congress being extremely active participant. So that's like the sort of first part. The second part, which I think the courts are going to really have to decide, is this concept of impoundment. And what impoundment is that, and it's playing out right now in terms of different interpretations of this power. Is that traditionally, at least since 1974, definitely, which is when the Impoundment Act was signed into law, Congress through their Article One powers appropriates money, and like the executive branch has very little say about how that money is spent. Right? If you think about it, like they want to spend $100 million on this program for crops, to deal with a bug. It's $100 million. It's not like there's any give. Congress has decided you need to spend $100 million. Now, the administration is taking the vein that there's some things that you can spend money on, and other things that you necessarily can't. And they're using what they would call their Article 2 powers, which is the take care clause, which is that the executive is supposed to take care to execute the laws effectively. Now, this sort of conflict in terms of the powers of the presidency is going to make its way to the Supreme Court. Like that is like something the judiciary is going to have to decide. Uh, I think from a fixed income investing perspective, uh, we right now, once Congress passes laws, we actually have a very good idea. And the CBO, the Congressional Budget Office, and the Office of Management and Budget, et cetera, all these data sources give us very good insight in terms of what spending is going to be like this year and next year and following year. So you have a very good sense of what fiscal policy is going to be like. I think, if there's a reinterpretation of those powers, fiscal policy becomes a lot more volatile, because literally, you can have a change in the presidency, and then a whole bunch of like bills may or may not get relitigated, uh, through the use of executive power. So like this is like a big deal. And for the bond market, it's a big deal too, in the sense of understanding what you call like how the money is raised and how the money is spent. Because federal spending is an extremely large part of the economy. And you really have to have a good sense of what deficits are, not just like the percentage number, but literally how much money is moving out the door on a daily or monthly basis. So yeah, like that's kind of what I think the issue that Doge kind of arises versus what you traditionally think of as like deficit reduction, just in an absolute sense.
Amar, you mentioned deficit spending, and certainly spending is something we always talk about on a year by year basis. But I know a lot of the clients of the financial professionals that we work with are really, really spooked and concerned by the level of debt in the country. And I'll have to admit, for the 30 plus years I've been in the business, we've always kind of heard the same thing about the debt. Like it's getting to this tipping point, it's getting insurmountable, it's going to result in persistent higher and higher interest rates and so on and so forth. And look, when you look at those graphs and things like that, it does scare you. But from a fixed income standpoint, you're kind of you've studied this, you've looked at it. How should we be thinking about the deficit in the United States right now? Is it time to push the panic button? Is it within the realms of expectation? Is it not a problem at all? Kind of where would you say we're at?
Well, yeah, look, that's a big and sort of complicated and sprawling question, and everyone wants to give like one sentence answers to it. And the answer is, as in most things, particularly markets, like there is no straight one sentence answer. So you're right. You've been hearing it for 30 years, right? Like, and I think the first thing is that we're a very wealthy country, right? Like you can say there's roughly 30 plus $1 trillion, 36 trillion on the liability side of the federal balance sheet, but then you look at like the sheer productivity dynamism of the U.S. economy, of like one of the wealthiest nations in the history of like uh, literally of our modern history. And it's like, well, like that's what's on the asset side, right? Like it's not, oh, there's cash here, there's bonds here. It's the sheer sort of productivity um, of the U.S. economy. So, and I think that's an important point to make, because different countries have different amounts of debt. Uh, and we cite the United States as having a significant amount, but then you could look at the government of Japan, and they have twice the amount of government debt. And from any visit to Tokyo, which I always recommend to people, it's a thriving, dynamic place with a high standard of living, and it hasn't fallen into some kind of black hole because there's too much debt. Uh, that doesn't mean like there is no number, right? The right question is, and this is what I think serious academics, policymakers, market practitioners have to sit down and really think about, is what's the optimal amount of debt, right? And some people might say zero, and then you'd say, well, there's no treasury bond market. Is that a good thing? And if you're pushing that, you might say, oh yeah, maybe fine, we can live without a treasury bond market, but that seems strange. You would want to live without a the risk-free security that everyone uses, public sector, private sector, to kind of hedge out portfolios. Okay, but let's say you could live without that. Well, then where do you recirculate these dollars, right? Like you can only put so much in a bank account. Right? The FDIC has like a limit, right? So you have to like the work, like what I call like the sort of planning and thoughtfulness of trying to understand debt dynamics is, well, how much do you want? At what point does it become a problem for your market infrastructure, right? Like it becomes harder to trade it and things like that. What's the right level of treasury securities that should exist for a country that's the reserve currency of the world, right? Like it's the reserve currency, and the treasury market is like the other side of that coin, right? Like if you can imagine the dollar is the reserve currency, the treasury is the reserve security. So you take all of that and you're like, that's all in the national interest to some degree. So what is the right stock of debt? I don't have that answer, you know,
Mhm.
but but it's like that's kind of where the nexus of the debate should be. And then if you think you need a substantial reduction, well then, the rebalancing has to take place either on the revenue side, right? Or it has to come through the expenditure side, or some series of both. And then if you're on the expenditure side, well, we just talked about like what you call like the white hot third rail. I mean, if that's the right term for a
Mhm.
third rail, like what of sort of American, economic management, which is the Social Security, Medicare programs, and then defense. And particularly in an increasingly unstable world, like, do you necessarily want to touch defense? I don't know. Like, that's something for the public debate. Well, do you want to touch Social Security or Medicare? Well, again, like, you have an aging population. Like, do you want to do that? Like, so this is kind of the nexus. The Simpsons Bowles Commission came closest to, I'm not saying I'm for or against their recommendations in one way or the other. I'm just saying they attempted to kind of do this, and it never even came up really for a vote. So it tells you that like there wasn't that appetite. Now, do I look at like treasury markets right now and say, hey, there's like a huge problem? Well, the markets themselves don't say there's a huge problem brewing. Um, there's some things that are telling you that, yeah, the supply of treasuries is making things a little bit sludgy, is the right word in markets. If I look at something technical called swap spreads, like that might be the case. My colleagues talk about something called term premia a lot, which is the additional premium bondholders need when there's like a lot of bonds out there. But none of those levels are what you consider like particularly extreme. So, and then you have thoughtfulness and time to work on this and come up with a solution. And remember, in America, like sort of big changes over time usually require buy-in, like a societal buy-in, right, over the course of multiple decades, so that no one's just unwinding what the other is doing. And that's kind of like how I think the debt sort of dynamic discussion, which is both an economic, a market, and societal one, needs to sort of take place.
Got it.
That was a long-winded answer. Sorry, but I promised
No,
it
that's
wasn't going to be
okay.
one
That's
sentence either.
It's a
Yeah,
it's
sure.
it's a long-winded question.
Yeah.
absolutely. So maybe we could shift gears a little bit and think about, if investors want to get an idea of how bonds could perform going forward, what should they be looking at? And I know you just started to touch on that, but maybe we could peel back the layers a little bit and dig into maybe it's a little bit of a crystal ball moment here.
Well, look, you look at what bonds are there to help you do is kind of deal with some of the uncertainty that just inherently exists in markets. Uh, Bonds are there to be a diversifier when the economy unexpectedly slows down, when there is a recession, when the animal spirits of risk on all of a sudden make themselves scarce, and they're there to preserve capital. That's like the first and starting point of what I'll call the high quality bond market. The second thing that a bond is supposed to do is it's supposed to pay you some coupon or income, uh, and that's there for the opportunity cost of not doing something else with these bonds. Now, for a number of years, particularly following COVID, you were really not getting paid that income, and but bonds were still an important part of a portfolio allocation. It's just that the bar to add them was higher, right? Like because you weren't being paid that income. Well, in the course of like after 2022, there's almost been like, in my view, a renaissance in the bond market. It's almost like a brand new market has sort of sprung forth. Like the yields are attractive, and yields are a very, very sort of important driver of how you should think about like just what we call expected return, or over the intermediate term in markets. And those yields look like attractive. I'm not saying things can't go wrong. You could have reigniting of inflation, but we've brought inflation down really significantly from its peak point, just over a year and change ago. Uh, and it's now it's not at the 2% target, but it's much much closer. Um, from that perspective, like you have these attractive yields, you have this asset class that's there to serve as a diversifier during ideally substantially down equity markets. And to me, like it makes it such a compelling place to think about from an allocation perspective in a way that it certainly was hard to make that argument, to the same sort of vehemence as you were like, just after COVID.
Mark, one thing that strikes me is that the investing public really has short memories when it comes to, you know, favoring one sector over another. So, as an example, we're coming off of back-to-back years of 20% gains in the S&P 500. And you may have some investors saying, why in the world would I even want to own a bond, right? The return has been so terrific in equities, and yet I think there's many financial professionals that say, look, market's kind of the equity market's a little bit expensive right now. We're near or at all-time highs. Sometimes you get that sinking feeling in your stomach, like how long can this go on? But what's an objective tool that you use to kind of think about the relative attractiveness of the equity market versus the fixed income market, and maybe give me some ammunition for talking to that client who forgot there even is a bond market out there.
Uh, yeah, I mean, I think like just the one easy kind of place you can kind of look, and it's simplistic, it's not perfect, is you can look at the current S&P earnings yield versus like the 10-year treasury rate. And you'll find that they're actually relatively close to each other. And that's usually not the case. Usually for significant periods of time, the 10-year treasury rate is below what the S&P earnings yield has been. And the periods where they sort of meet or the 10-year treasury rate is above that, it tends to meet, for me at least, is an indicator that fixed income is an attractive opportunity set relative to the equity market. And again, I'm using the 10-year treasury, like the most vanilla of vanilla bonds, right?
Mhm.
And that's not a bond portfolio. A bond portfolio can be more sophisticated and nuanced, like using everything from agency mortgages to investment grade corporate credit. And if you're looking for even additional income, like the high yield bond market or the bank loan market, like a number of places. So just from a relative value perspective, like I think, like to me, that's an important signal. It doesn't mean like things happen tomorrow or the day after. It just means that, like, if you're getting your ducks in a row, like at least some signal is showing you that it kind of makes sense to do that.
Mhm.
But let's say you don't want. You're like, okay, I get it. I need to think about some form of capital preservation. I need to think about diversification, uh, and I want to take a little bit of that and put into higher quality bonds. Fine. Um, the other part that it's worth thinking about is, but I don't, while like the 10 years attractive, in that mid four range, and maybe a good high quality core plus portfolio gets me somewhere in the fives or more in yield, maybe a lot more. Well, okay, that's what the credit markets are for, right? And they occupy, in my view, that gray space between the equity markets and the highest quality fixed income markets. So you're getting, uh, substantially more yield. And there is a little bit more risk, but historically, it's less volatile than the equity market. So it's a way of kind of trying to capture some continued upside return, um, but still, trying to make your overall asset allocation less volatile. And then finally, like, there's the point of like, okay, but I don't want to have to sort of think about chopping up my bond portfolio like that. Well, this is why you have more flexible mandates, right? Like, if your manager has flexibility, in some cases, they can have a lot of flexibility. They can be in credit, or maybe they just want to be in treasuries because that's the best risk adjusted return they're seeing. Maybe they want to be in medium term treasuries, or they want to be in slightly shorter dated, and they're calibrating almost constantly. Excuse me, dry air. Uh, what that allocation looks like. And then, of course, because we're speaking mostly to an American audience, I find that it's always just worthwhile mentioning there is a bigger world than the United States when it comes to the bond market. And for years, right, it's something you could ignore because Japanese interest rates were like near zero and European interest rates were like near zero. Well, guess what? Like they're not now. Those rates have moved up. In some cases in Japan, they're continuing to move up. In other cases, like in Europe, like they've moved up, but they're coming down a bit. So like there's now like this diversification that can exist in the bond market that can be very attractive, and also lets you take advantage of the fact that some country economies are slowing and some are still on sort of like a pretty fast track, like the United States is, or Japan is, and giving your manager that flexibility, I think, just gives you additional tools for asset allocation.
Amar, I know in your monthly commentaries that are posted at hartfordfunds.com, and for those that have been reading those and following along, you've been highlighting the benefits of a flexible, unconstrained approach. Is this what you've been referring to? And if so, can you maybe dig a little bit deeper and just give a few more examples of this as being an attractive way to invest?
Yeah, look, if you buy, like I always think of like something like core bond or core bond plus is like the meat and potatoes of a bond allocation, right? It's very straightforward. You have the manager has a little flexibility, but it's not a huge amount. So like portfolios can change a bit, but like really the mandate can be it's a little bit more constrained. And look, that has served its purpose for many years, and I still think it will serve a very very strong purpose when you're when you're dealing with a world where we're trying to figure out tariff policy with budget reconciliation, with what's happening with conflict in on a 3-hour flight from London, and growing sort of geopolitical tensions and so on. Well, like some of these things are what you call decelerators of growth. Others, decelerators of growth and inflation. Others are accelerators of growth and inflation. And trying to find out like when those, when one policy conflicts with another policy and really understanding what that outcome is. Well, that's where you really kind of want to give your manager some flexibility, right? So that could mean, for a while, as the US economy really was running hot, and you know it didn't necessarily make sense to have a ton of interest rate risk in your portfolio. You could have a little bit and you could still be earning great yields. Now like the curve is steeper, like it's shaped in a different way than it was. Well, you might want to move out the curve a little bit, and there is signs that the economy is not as white hot as it once was. That's natural. There's like a natural deceleration effect. um, you could still find some parts of the credit market attractive, but not others. And it's nice that the manager has that like mandate to kind of find like the more attractive parts of the credit markets, and then try to come up with a way of capturing what we'd call the best parts of that risk premium from our perspective. Uh, or like they might not find any of it attractive and kind of like shy away from it. So like having that flexibility in a world that to me is probably as dynamic as it's ever been in my 25 plus years in capital markets, I think is a useful thing. It's a useful lever. And it's something that I find it's not a replacement for all bonds, but it's a great like addition, right? It's a great additional set of tools to your fixed income allocation. And to me, I think it's going to be one of the most dominant ways people will sort of seek to garner like returns from fixed income markets in the coming years.
Well, Mar, I know it's difficult to pack your crystal ball in your carry-on bag when you travel across the country, but this is my favorite part of the podcast because I'm going to ask you to break it out, and I am going to give you and your colleagues credit because, back last year in 2024 when people were talking about continued cuts, I mean, you were among some of the first saying, "Hey, not so fast. We're not sure cuts are going to continue at this pace." But what's your best case scenario for where you think the Fed is right now, and maybe just a long shot prediction through the end of this year? Where do you think they'll be based on everything we know at this point?
Oh yeah. So I think a couple of, and this is, with no crystal ball in terms of, end tariff regime or exactly what the budget reconciliation are. By the way, which is like saying ignore the 800-pound
Right.
gorillas. Okay. Um, that I'm a little bit more optimistic. I think, there is a chance still of like one cut near the end of the year. I think I'm sorry, the bar is pretty high for Powell. January effects in inflation tend to be a bit higher relative to the rest of the year. And hence the January inflation numbers came in a bit hotter than you'd expect. The real sort of challenge, John, I think the sticky part here in inflation is the housing market, right? And until shelter inflation costs continue to come down, uh, or at least the data needs to show that, the Fed doesn't really have as much freedom as it would want at this part of the cycle. And we're seeing a gradually cooling economy. It's not, I don't necessarily view one as one of reacceleration. And uh, again, not knowing what exactly is going to come out of the budget reconciliation process, I expect with the debt ceiling and the continuing, resolution to try to fund the government because the government technically could shut down in mid-March, you'll probably see a few less sort of federal dollars pumped out, at least this year, as just things get slow walked a bit. And if that's the case, that's also probably a little bit cooler on the broader economy. Um, like so from the good part of what I just said is it's very we're very unlikely, not impossible to have, but unlikely to go through that very high battle of inflation we had in 2022 to 2023, because a lot of that was supply chain driven and some demand as well. But a lot of it was the closing and opening of the world's largest economies. Like that's a little bit less likely. but we have to wait and see on the tariff front because, tariffs could be a one-time shift in price, or they could be, continuous shift depending on how they're structured. And then if there's retaliatory tariffs, like that could feed through. And then, John, like the other thing, of course, is what the reaction function is of the central bank. Does it view it as a one-time move that they look through? And I don't think any of that has really played out yet. And I think they're just gonna have to await data and kind of view that. So the crystal ball is foggy. I mean, but that's understandable.
Which also then makes the case for what you just said about an unconstrained approach, where we're trusting managers who have their fingers on the pulse to try and figure out where the most appropriate allocations might be.
Yeah, I completely agree with you on that.
Amar, before we wrap up, I would love if you could share maybe 2 or 3 talking points with our audience about fixed income that they could use with their clients in their next conversations. I know we covered a lot of territory and we definitely got into the weeds, but what would you say would be some of the high level bullet points that they might be able to turn around and share with clients as they engage in these conversations? Because I know it's top of mind for everyone these days.
Um, the yields are attractive, and I think that's just a great starting point to begin a fixed income conversation. Now, longer dated yields are higher than most shorter dated yields, so the curve is more normally shaped from that period when things were inverted. So I think those are all like things that are good starting points when you begin a fixed income discussion. And then I think there's just the continuous reminder that the role of fixed income in your portfolio is to serve as that diversification for an economy that could rapidly slow, or if the sort of exuberance of the equity markets wears off. Well, you want something that's going to help protect you, not just from a capital preservation side, but in the meantime, you're getting income. And then secondly, you'll get total return if there is that sharp downward movement in rates. So to me, like it's an attractive time to do the homework on fixed income. And homework doesn't sound like a lot of fun, but when you look at like the broader opportunity set in fixed income, at least to a bond geek like me, it is fun. Like there's a lot of interesting things to look at and spend time on.
Well, Mar, we always appreciate your words of wisdom, and we may come back to you in a few months and ask you to polish up that crystal ball. I especially like, though, that you gave us and our listeners some things to look for out there in the development of policy and so on and so forth. So, on behalf of all of our listeners, thanks for the time that you've taken today to educate us about where things stand right now, and we look forward to speaking with you again in the future.
Thank you guys for having me on.
Thank you.
Thanks for listening to the Hartford Funds Human-Centric Investing Podcast. If you'd like to tune in for more episodes, don't forget to subscribe wherever you get your podcasts. And follow us on LinkedIn, Twitter, or YouTube.
And if you'd like to be a guest and share your best ideas for transforming client relationships, email us at guestbooking@hartfordfunds.com. We'd love to hear from you.
Talk to you soon.
Investing involves risk, including the possible loss of principal. Fixed income security risks include credit, liquidity, call, duration, event, and interest rate risk. As interest rates rise, bond prices generally fall. Investments in high-yield junk bonds involve greater risk of price volatility, illiquidity, and default than higher-rated debt securities. Loans can be difficult to value and less liquid than other types of debt instruments. They are also subject to non-payment, collateral, bankruptcy, default, extension, prepayment, and insolvency risks. Foreign investments may be more volatile and less liquid than U.S. investments and are subject to the risk of currency fluctuations and adverse political, economic, and regulatory developments. Diversification does not ensure a profit or protect against a loss in a declining market. The views expressed herein are those of Wellington Management and are for informational purposes only, and are subject to change based on prevailing market, economic, and other conditions. The views expressed may not reflect the opinions of Hartford Funds or any other sub-advisor to our funds. They should not be construed as research or investment advice, nor should they be considered an offer or solicitation to buy or sell any security. This information is current at the time of writing and may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management or Hartford Funds.